Today we are going to do a deep dive analysis into Cisco. And when I say deep dive, I'm not kidding. I'm going to cover the latest earnings call of Q4 fiscal year 2020, revenues, margins, net income, dividends, management, their moat, valuation and their future. This is by far the most in-depth analysis I've done so far, and I will explain at the end why I think Cisco is still transforming but has good prospects for the future. Hi, and welcome to the Dividend Attitude. I'm Tom, and I'll show you a lot of different aspects of Cisco today to see if they are worth buying. Full disclosure, I already own shares of Cisco. Let me begin with the most recent events. The latest reported earnings Q4 of fiscal year 2020. After that, Cisco dropped from about $48 per share to now below $40 per share. So what happened? Their revenue dropped across the board and was down year over year. People expected better results due to an increased demand in WebEx. The forward guidance for Q1 2021 is not looking good. The CFO is going to step down. With the third point, their forward guidance being the biggest factor into the decline in share price. During this video, I will touch upon all these points and give you my take on it and why I think it is not as bad as it looks on the surface. Before we start diving in, let me rewind a bit and already give you a clue as to why I think Cisco is still doing what it set out to do. The story of Cisco is that of a company in transformation, transforming from their legacy hardware business to a more diverse company with a solid focus on software and recurring revenue through subscriptions. Their focus is also on delivering their products as a service, again with the aim of producing a more predictable revenue stream. In 2017 they had set themselves a goal to have at least 30% of their revenue coming from software, and in Q4 of fiscal year 2020 they achieved that with 31%. For a tech company this is an important aspect because recurring revenue offers a more reliable stream of income. First, the market cap. At the time of writing, the market cap of Cisco is 172 billion, which is considered mega cap. The beta of Cisco is 0.84, so that is less volatile than the overall market, with the overall market having a beta of 1. Cisco has underperformed the market by quite a bit. Year to date they are down a little less than 16% and their 5-year performance is a gain of 58%. And then the stuff that gets me excited as a dividend growth investor. The dividends. The current yield stands at 3.61% at the time of recording. This is quite a bit above their 5-year average yield of about 3%, which could point to undervaluation. Cisco recently became a dividend contender on the Champions, Challengers and Contenders list. They now have 10 years of dividend growth under their belt. Seeking Alpha only shows a dividend growth history of 9 years, but Cisco already started paying a dividend in 2011 and increased it every year since. Because Seeking Alpha has only recorded 9 years of dividend growth, there's no 10-year dividend growth rate yet. The 3-year dividend growth rate is a bit under 12%, while the 5-year dividend growth rate is a bit over 13%. Unfortunately, the 1-year dividend growth rate is only 3.6%. The earnings payout ratio of Cisco is at 46.7%. It has been above 50% a few years before, so that still looks good and is well below my maximum threshold of 70%. The free cash flow payout ratio is a tad lower and comes in at about 41%, based on the just reported fiscal year 2020 numbers. Cisco has an excellent dividend safety score of 91, based on a good free cash flow payout ratio, a strong balance sheet and a good cash flow generation. If you liked the video so far, don't forget to crush that like button and make it turn blue. If you enjoy videos like this, consider subscribing because I will do more of these in the future. So now it is time for the financials of Cisco before we take a further look at the company that Cisco is. The revenue of Cisco went from 43.2 billion to 49.3 billion for a meager growth rate of about 1.6%. Like I mentioned at the beginning, the revenue of Cisco did drop year over year by about 5%. This is mainly due to smaller commercial customers putting off spending money on updating their network equipment. And because the infrastructure segment is still about 55% of their revenue, this hurt the results of Cisco particularly bad because this segment fell by about 16% year over year. But the bright spot is that Cisco is still making progress in their transformation because in fiscal year 2020, about 51% of the revenue came from recurring software and services. The gross margin of Cisco is quite stunning at 64.3%, which is actually at its highest point in 10 years. Compared to some of its competitors, it is tied with Qualcomm, a bit lower than Microsoft and higher than Intel, IBM and Amazon. The operating margin is quite a bit lower at 28.6%, but still really good, and also at the highest point in 10 years. Compared to competitors, it is a bit on the lower end because only IBM and Amazon have lower operating margins. The net income of Cisco went from about 6.5 billion to around 11.2 billion for an average growth rate of about 8%. The big dip in 2018 is because of a 10.4 billion charge due to the enactment of the Tax Act, so discarding that, the net income does look good, although it has been relatively flat in recent years. The free cash flow generation of Csco is good, with 1.64 per share in 2011 and 3.47 in 2020, for a growth rate of about 12.4% per year. One of the reasons I bought Csco in 2017 is their low debt levels. In 2011 they had a debt to equity ratio of 0.34 and in 2020 0.31. With a few minor spikes in between, the trend looks very good still. For Csco, the current ratio stands at 1.72, which is still good, but has been much higher in the past. If you look at the quick ratio, the same trend is visible here as with the current ratio. The quick ratio is still decent at 1.58, but has been quite a bit higher in the past. The return on equity is looking great at 31.4, which is also at the highest it has been in 10 years. Comparing it to some of its peers, it is right in the middle, with IBM, Microsoft and Qualcomm all doing better, while Intel and Amazon did worse. The same applies to the return on invested capital, which is at a bit under 20%, at the highest point as well. Compared to its peers, we see the same picture as with the return on equity. Only this time, Qualcomm, Intel and Microsoft are doing better than Cisco, and IBM and Amazon worse. The S&P credit rating is also looking pretty good with a rating of AA-. So what products, segments, customers, competitors and what kind of moat does Cisco have? All important facts to consider when analyzing a company. Cisco is probably most well known for their routers and network equipment, but nowadays they have a whole range of tech products ranging from networking, security, collaboration applications and the cloud. Coming back to the earnings call, investors expected the growth of WebEx, Cisco's competitive product to Zoom and Microsoft Teams, to have a substantial impact on the revenue. But unlike Zoom for example, Cisco has a wide range of products. According to CEO Chuck Robbins, WebEx did have double-digit growth. But WebEx is only a certain portion of the total revenue. WebEx revenue is not disclosed though. Cisco continues to focus on the network as their customers add more and more connections and as more applications move to a multi-cloud environment. The vision of Cisco is to deliver highly secure, software-defined, automated and intelligent platforms for their customers. The strategic priority of Cisco is on accelerating the pace of innovation, increasing the value of the network and transforming their business model. Cisco reports in 5 business segments: infrastructure platforms, applications, security, other products and services. They have a wide range of customers in a lot of different industries. From the city of Copenhagen in Denmark and city of New Orleans to Audi and Domino's Pizza. In the past 3 years, no customer has accounted for 10% or more of the total revenue, ensuring they have a diverse revenue stream. As for the competitors, with such a diverse product portfolio, they have a wide range of competitors as well. In the networking space, one of their competitors is Juniper Networks. They also mention Amazon, Broadcom, Dell, Hewlett-Packard, Huawei, Nokia, Slack and Zoom as some of their competitors, all relative to only some of their products. Interestingly though, Amazon and others are also collaboration partners. Seeking Alpha sees IBM, Microsoft, Intel and Qualcomm as some of its peers. If you want to know more about Intel, I've also made an analysis on Intel in episode 29, which is now suggested in the top right corner. Cisco enjoys a variety of moats. They enjoy an economies of scale moat because of their high level of expertise in the networking area, though this moat is not quite as wide as it used to be because of the move towards the cloud. But most companies still need an internal network, so Cisco has its focus on what they call the multi-cloud environment. They also enjoy a brand moat. Almost everyone has heard of Cisco, and they are known for their quality products. This focus on quality has resulted in long-lasting relationships with their channel partners like telecom providers and system integrators, which they are able to sell a large amount of their products and services through. If you want to know why a sustainable competitive advantage or a moat is important, be sure to check out episode 11, in which I thoroughly explain all the ins and outs of a moat. It is always important to check in on the quality of the management. In this episode I will pick out a few qualities to illustrate the quality of Cisco's management. If you want to know which other criteria there are to judge management quality, be sure to check out episode 9, now suggested. One of the first aspects I like to check is the length of tenure. How long has the current management been on? Chuck Robbins became CEO of Cisco in 2015 and has actually been with Cisco for over 20 years in several high-end management positions. Most of the other executive officers have been with Cisco for over 10 years as well. The CFO, Kelly Kramer, has been with Cisco for about 8 years. But she actually announced in the latest earnings call that she will be looking for a replacement. Cisco seems to be able to further transform its business to a service and software-oriented company with more and more recurring revenue since Chuck Robbins became CEO in 2015. And based on their debt management, capital allocation, return on equity and return on invested capital, the management seems to be performing well. During my research, I did find quite some criticism on the management team though. What about valuation? Are they worth buying right now? On FastGraphs, Cisco is shown as undervalued, and based on estimates of 23 analysts on FastGraphs, Cisco could return 15.4% annually if it would return to fair value at the end of 2022, the orange line. The blue line indicates what the normal PE is of what the market usually values Cisco at, and as you can see, that is even higher than their fair value. The fair value on Finbox also indicates that Cisco is undervalued, based on the current price of a bit under $40 at the time of recording. They estimate the fair value of a bit over $44, indicating an upside of 9.5%. Finbox uses different valuation methods to come up with their fair value estimate. Morningstar shows a PEG ratio of 2.6. The PEG ratio is the price to earnings to growth ratio, so that takes future growth into account as well. In general, a PEG ratio of 1 or below would be considered undervalued, but it is best to compare the PEG to companies in the same industry. Comparing it to its peers, it is interesting to see that based on the PEG ratio, Cisco is actually considered the second most expensive stock after IBM. So the key question is always the future. What will the future look like for this company in transition? The CEO Chuck Robbins stated in the latest quarterly earnings call, Q4 fiscal year 2020, that they will continue to focus on multi-cloud investments, 5G and Wi-Fi 6, AI, optical networks and more investments. They've also mentioned that they are moving more aggressively to sell a large portion of their portfolio, including the infrastructure segment, as a service. I think that is a good move, because that means more reliable and recurring revenue for Cisco. While doing research, I also came across an excellent analytical article of Chuck Walston on Seeking Alpha, which I will link in the description. Although I don't fully agree with his premise, but then who am I, right? He brings up some potential developments that could act as growth catalysts for Cisco. The recent acquisition of Luxtera, which could lower costs and increase scale on the network optics front. The Cisco iOS XR7 network operating system, which Cisco claims improves network security, performs faster and more efficient, and increases network visibility. Silicon One is Cisco's first entry into chip making. The premise is that this chip is a unified programmable application-specific integrated circuit, or ASIC. Did I lose you there? Basically, it is a chip intended for a single purpose: networking, which is the first in the industry. In short, this is big news because it allows Cisco to sell this chip to other companies and possibly get them back in the hyperscale cloud providers game. If you want to read more about this, I've put a link to a Forbes article in the description which provides a bit more information on this. This is all part of Cisco's Internet for the Future strategic initiative, where new technologies such as 5G, 16K streaming, virtual reality and AI are going to put an increasing strain on networks that it currently cannot handle. Looking at analysts' expectations on FastGraphs, they expect earnings per share to shrink in fiscal year 2021, which started this quarter for Cisco, to 3.10 earnings per share and grow 7% in fiscal year 2022 to 3.33 EPS. This is precisely in line with the expectations of analysts on Yahoo Finance as well. I think the aforementioned initiatives need some time to fully flourish, and I also know from working at a big IT company that it takes years to really transform your business to a recurring revenue business. So I believe they will eventually transform their business to a more recurring revenue stream. While Cisco is struggling now and has been for a while, I will continue to hold them, because I believe they have the knowledge and company DNA to keep innovating and keep transforming their company to a company that is receiving the majority of their revenue from recurring revenue based on their service contracts. In the meanwhile, the dividends are well covered. They have a very solid balance sheet, so I will keep collecting those dividends along the way. I hope you enjoyed this video, and if you came this far, I guess you did. Let me know your thoughts on Cisco in the comments below, and consider subscribing to stay updated on future content. Until next time, bye bye.